SMCI is mooning right now in the stock market. NVIDIA is about to release earnings and it's going to be massive. Are stock market valuations overextended? Are they underextended? We're going to break down everything down in this video, and then I'm going to show you some stocks that are on my watch list and the exact trades that I plan on making on these stocks. You can make a bunch of money, so we're going to go into that in just a second. Heading over to my trading account super quick, $888,000 we're at right now. It's looking pretty good over there right now. So I break everything down in my alpha report. It's 100% free. Just click right here. Let me read it first. You don't even have to put in your email. And then alpha report issue number 10 is the one I just came out with. So we're going to go through everything that I talked about in the stock market. NVIDIA's make or break time right now. They're about to report earnings. It's going to be really big for the whole AI sector because it's like NVIDIA is the #1 company in that sector. So if they do bad, they can really bring down a lot of the stock market with them, because AI, in my opinion, is the next big revolution for the stock market. And in my opinion, I feel like this is like the iPhone moment for AI. I feel like we're just getting started with this stuff. So we're going to break down NVIDIA. We're going to break down SMCI. I have a new stock watch list. We're going to go into that in a little bit in this video. I'm going to show you all the stocks that I have my eyes on and all the potential plays that I might make. And then we're going to go through my strategy, how I make $30,000 per month in the stock market with stock options. So let's break down everything that we talked about today. So 30-year bonds are right around 7%, not really much movement with that today. 10-year treasury bond, pretty much flat on that today also. Fear greed index, I like to look at this because the #1 thing about the market is it's like the market moves on fear and greed. So when we're over here in this extreme greed category, I don't really like to buy stocks in this area. I mean, this is just one indicator, but this one indicator, it's pretty good, honestly. So right now we're pretty much neutral in this area right here. And remember, the famous Warren Buffett quote, be greedy when others are fearful and be fearful when others are greedy. So when there's extreme fear in the market, maybe we're on a dip, this is the time when you want to be greedy. But when people are greedy, that's when you want to be fearful. The market could be a bubble over here, but the market could be a discount over here. So we're pretty much right down the center right here. So that is okay. So let's break down SMCI first. So they appointed a company called BDO. This is an independent auditor that's basically going to go through their books and they're going to say what is true and what is false. And the reason why this matters is because the fact that BDO took on SMCI as a customer, that shows you that they can stand behind the books that SMCI is reporting. What I mean by books is like the accounting that they have been doing. If the books were that bad, they wouldn't do it. But the fact that they took on SMCI as a customer, it goes to show that the books might not be as bad as we expect. I mean, just look at this chart right here for SMCI. I mean, this right here is a 1-year chart. And in March 13th of this year, the stock was at 118 bucks per share. Right now, even after the big move that happened today, this little bump that happened right here, the stock is only at 28 bucks per share. So check this out right here. The PEG ratio for SMCI is under 1. So that is a price earnings growth ratio. So basically, if the earnings go up by just say 50% year over year and the stock only goes up 40%, the earnings are going up faster than what the stock is going up. So that shows you that the stock could potentially be undervalued. On top of that, the PE ratio for SMCI is around 8 right now. 8 is totally unheard of. I mean, typically for a company that's growing as fast as SMCI, it's probably going to be around like 30 or 35. So there could really be a lot of upside in this play right here. But of course, there is still risk with the accounting issues that have been going on. So this PE ratio of 8 that's happening right here, this PEG that's under 1 right here, and this huge dip that happened right here all the way down here, if we go up to the fear greed chart, if I were to plot SMCI on this fear greed indicator, I would definitely put it somewhere around like 1 or 2. I mean, it would be really, really low. And guess what? When there's extreme fear in the market, that is when you potentially want to be buying into the stock. Now, don't get me wrong. It's not all going to be easy for SMCI. I mean, SMCI, they did a lot of accounting fraud, and there's been so many accounting firms that have passed over SMCI that didn't really want to dive into their books. So it did definitely take some time for them to get BDO on board to be able to go through these books, sift through it, bring it up to compliance, and hopefully they don't get delisted on the NASDAQ. If they get delisted on a NASDAQ, that's going to be horrible for the stock. I mean, the stock is going to totally crater, but in my opinion, the fact that BDO brought them on as a customer, I feel like we're going to be looking back on this moment maybe 5 years from now, and it's going to be like, yeah, that was a bad time for the stock, but guess what? That was a super good time to buy for the stock because it was in the dumps. I mean, these ratios right here are totally mind-boggling. I mean, a P ratio of 8 and a PEG ratio under 1, that is awesome. I'm probably going to make plays on that, and then we're going to go through my watch list in just a little bit. I'm going to show you the exact trades that I plan on making on SMCI. All right, so now heading down to NVIDIA. So NVIDIA did pop 5% today. There's been some analysts on Wall Street that are basically saying the chip demand for NVIDIA has been pretty strong. So that's definitely going to help out the stock. And the stock did have a lot of volatility in the last month because there was a rumor that the Blackwell chip that is reportedly going to come out at the end of this year, it's been having overheating issues. And if they have to delay the Blackwell chip, that really could do some damage to the earnings for NVIDIA in the short term. But just think about it. If they delay the Blackwell chip maybe 2 or 3 months, does it really matter in the long run? For me, no. So for the record, I don't have a position on NVIDIA right now, but my hope, which who knows what's going to actually happen, but I'm hoping they're going to come out with the earnings tomorrow and they're going to say they are having issues with the Blackwell chip. I hope the stock takes a dip and then I will swoop in. I'll probably buy calls, I'll buy shares, and I'll sell puts, and I'll probably make a lot of money on that because eventually the Blackwell chip probably will come out and it will be fine. And once that comes out, it starts scaling and it starts hitting the bottom line, the stock will probably recover and we'll probably make a bunch of money. Now, if the stock doesn't take a dip and it absolutely moons, I'll consider what I'm going to do on that play. And just think about it like this. The number one thing that matters with earnings is number one, what the earnings actually are, but number two, what are they guiding going forward? The guidance is the number one most important thing for the stock. Guidance is just how much money do we expect to make going into the future? How is demand for these chips? Because NVIDIA is at a $3 trillion market cap. It's a huge valuation, which right now it is justified, but they are growing earnings at roughly 50% per year. And just the law of large numbers, it's so hard to grow at 50% year over year over year over year. Eventually that growth is going to have to slow, and that's when the market is going to reprice NVIDIA with a lower PE ratio. So then what I said right here is NVIDIA has been on my watch list and I plan to add shares, especially during times of high volatility, because volatility is when I could potentially get NVIDIA for a much better price than right now. It has a forward PE ratio of roughly 50, but they're growing at like 50% year over year, so it is justified like I just said, but I would expect and I would be super surprised. I mean, I pretty much can guarantee it. This 50% growth year over year will eventually slow down. I can pretty much promise you that. And then if we go down here to my intrinsic value calculator, by the way, if you want to get this calculator for free, I'm going to put the link below in this video for that. 100% free, but we're going to go through it here and I'll kind of show you how I work it. But I also have a video of how to work it if you click the link below. So you plug it in as a stock NVIDIA. Earnings per share for the last 12 months was $2.86. I'll talk about what this means right here if you watch the video when you click the link, but this is a constant right here. Growth rate for the next 5 years, this is 50% annually is what I factored in for this. So every year I'm expecting 50% earnings growth, which in my opinion is a little bit too high, but I was giving them the benefit of the doubt for this valuation. And then you plug in the current yield of AAA bonds, which is right around 4.9%. So that spits out an intrinsic value for NVIDIA of $146. It's currently trading at $147 right now. So it's pretty much trading at intrinsic value right now. It's not a super deal. It's not super expensive. It's kind of like you're just paying MSRP for the stock. And then let's look at the market valuations right now. So the S&P 500 is currently trading at a forward P ratio of roughly 21, which is a little bit lofty. It's a little bit overvalued, but really not that much. I mean, it's like 5 to 10% overvalued in my opinion. The NASDAQ is roughly 26, but the NASDAQ can justify a higher PE ratio than what the S&P 500 can do because the NASDAQ is implied to have higher growth. More growth, higher PE ratio, that's fine. But keep in mind, interest rates are one of the most important things when it comes down to PE ratios because interest rates are like gravity on the stock market. So right now we're at 4.75%, but we're expected to be roughly 4% in 1 year from now. So that's roughly a 1% cut. I mean, this could be 3.75, maybe even more. So I just said 1% cut, and that does make a difference. But just think about it like this. You could get a 4% yield in a bond, and that is considered to be the risk-free rate, or you could go get a risky rate of return in the stock market for 10% per year. What are you going to do? I mean, is it really worth it to waste your time for a 4% yield? It's usually not worth it for the 4% yield, and that's why most people will go and put their money in the stock market, and when stocks become the only game in town, that will push PE ratios and valuations up in the stock market. This right here is just a chart of the PE ratios for the market. So we have the mega cap 8 going forward. That's a magnificent 8. You have the S&P 500, S&P 400, then you have the small caps. These are recessions in gray right here. So it does show you right here, we're a little bit lofty. I mean, this chart goes all the way back to 2000. We are a little bit extended on our PE ratios, like I said, maybe 5 to 10%. I think we're a little bit overvalued on that. But now going to my watch list. So this right here is everything that I have on my watch list, and these are my price targets. So you could just go through and read through this. I'm not going to read everything for you right here, but these are stocks that I'm looking at right here. A lot of these I already own, some I don't, some I'll initiate new plays on, and some I won't. And then this is what I got going on right here. So if I'm going to be making any new plays going into the future, this is probably what it would be. This is in no specific order right here, by the way. So I'll probably just dollar cost average in a triple Q, VOO, SOX, Tesla. Palantir, I do feel like it's overvalued. I would consider buying puts on it. This is definitely more risky of a play because Palantir has kind of like a meme factor to it right now. But the valuations on Palantir, in my opinion, are pretty stretched. And honestly, if you watched the YouTube video before this one, I'm going to go through the Palantir valuation. I'm going to break it all down for you. I just think it's lofty. Not saying it's going to crash or go down, but I really don't like the odds of going long on Palantir right now. I would rather go short, and going short by the way of buying puts, that would be the same thing as going short. Essentially, you just want the stock to go down. I think Google's pretty cheap right now. You could sell puts on that right there. NVIDIA, like I said earlier, I would be willing to buy shares on a dip and hold for 2 years, or sell a 1-year put with a strike of 130. So the current price of NVIDIA right now is right there around 147. So 147, I would like to go sell a 130 put. That is giving me $17 per share buffer. And that's not even counting for how much premium per share I receive. So I do like that trade right there, but I'm probably not going to make a trade on NVIDIA pre-earnings, to be honest with you. I really don't like to play earnings because there's so much volatility. It's really hard to make money around earnings. Honestly, it's like flipping a coin. I like to make plays that I have a high conviction in, and I don't really have a lot of conviction on NVIDIA before earnings. And SMCI right here, I would consider to buy calls with a 5-month duration. Strike price of 30 bucks. You know, I feel like this stock is extremely cheap right now, but there is still that downside risk. What if the accounting stuff comes back bad? What if they get delisted? Those are inherent risks right now to SMCI. So if you don't think that stuff's going to happen, you could make a lot of money buying calls on SMCI right now. And you can see right here my rate of return for the last couple years, 65% annually. And then right here, my investing strategy. I've been doing this strategy for years. This is how I make like 30K a month right now. Basically what I do, I'll dollar cost average in a VOO and triple Q, roughly 40% in each one, and then I'll do 20% individual stocks. I'll sell puts when I feel like the market is undervalued. I'll buy calls when I feel like the market's undervalued or the individual stock. And then I'll take those profits and them premiums and I'll go roll that back in the base of my portfolio. And I'll just continue that snowball year over year over year. And that's how I have millions of dollars right now. My strategy is simple, but the hardest part about my strategy is right here. It's hard for you to read, but the stock must be undervalued. That is the number one thing, and that is what I teach in my course. The link is below for that too. But if you don't want to go through my course, I'm going to link a video at the end of this video right here. It's me going through how I trade stock options. So definitely check that video out if you want to learn how I do it without going through the course. The video will help you out a lot, I promise you. And then you can see right here, I think that we're about 5 to 10% overvalued as a whole. So if the market takes a dip, 100% normal, don't be freaking out about it. And my account right here, $888,000 for my trading account. I do feel like we're overvalued, like I said. So if we do a 10% drop on $888,000, that's roughly $88,000 that this account will go down by in value. So I feel like the intrinsic value of this Charles Schwab account, somewhere around $800,000. If it falls 800K, that's totally fine. I feel like it's totally justified. And then final notes right here, NVIDIA is big for tomorrow. I'm definitely going to be eyeing what the earnings are going to be, the guidance, and what's going on with the Blackwell chip. SMCI is very, very cheap on a fundamental basis right now. It could be a solid dip buy opportunity, but there also is those risks with the accounting issues and a potential delisting on a NASDAQ. But at the end of the day, keep your emotions in check when there's pumps and dumps in the market. Continue to dollar cost average into quality stocks and ETFs at good prices. And when you find undervalued companies, use stock options to magnify your gains. And with that being said, that's what I got for you guys today. I hope this helped you out. Don't forget to subscribe to the Alpha Report, 100% free. You don't even got to put in your email. But if you want to get these reports right when I send them out every day after the market closes. Click the link below, drop your email, and you're good to go. Don't forget about my course if you want to learn how I trade stock options. I'm going to teach you everything I know in there. But if you don't want to do my course, watch this video right here, and I'll see you there.